Welcome to our deep dive into one of the most critical financial tools in business, the bank guarantee. We're here to explain the charges and key considerations you need to know. Hello, and welcome back to the channel. I'm so glad you're here. We've got an essential topic today for anyone involved in large contracts or international trade. Do you know exactly what factors determine the price of your bank guarantee? Or are you unknowingly paying too much due to unmanaged risk factors? Stick around, because the answers might surprise you. The problem is that bank guarantee fees often seem opaque. Without knowing the underlying charge criteria, businesses can struggle to budget accurately or negotiate effectively. This video solves that problem. By the end of this video, you will clearly understand what a bank guarantee is, the various types, and most importantly, the 4 key criteria banks use to calculate your fees. This will enable you to make informed decisions and optimize your costs. First, we'll dive into the definition and purpose of a bank guarantee. Then, we'll cover the different types, the essential charge criteria, a detailed example, and finally, crucial considerations for every applicant. Let's start with the basics. What exactly is a bank guarantee, and why is it used? A bank guarantee is a financial promise made by a bank to a third party, the beneficiary, assuring that a customer, the applicant, will fulfill a specific contractual obligation. You have 3 parties: the applicant, who needs the guarantee, the beneficiary, who requires the assurance, and the issuing bank that provides the financial backing. Bank guarantees aren't one-size-fits-all. They come in various forms, tailored to different contractual needs. Understanding the types is key. Bid guarantees assure that the applicant will enter into a contract after winning a bid. This protects the project owner from time and cost implications if the successful bidder backs out. Performance guarantees ensure the fulfillment of contractual obligations, like a contractor completing a construction project or a supplier delivering goods as agreed. Payment guarantees simply assure the payment of a specific sum to the beneficiary under predefined conditions. Advance payment guarantees protect the beneficiary if the applicant fails to deliver goods or services after receiving an upfront payment, ensuring those funds are recovered. Financial bank guarantees are often used to secure a loan or other financial obligation. Customs guarantees are used to secure the payment of customs duties or taxes, allowing goods to be released before final assessment. Now for the crucial part: understanding the 4 main factors banks consider when calculating your guarantee fees. Naturally, a higher guarantee value results in higher charges. Also, a longer validity period, meaning the instrument is outstanding for more time, generally incurs higher fees. The specific charges include the issuing fee, but also look out for amendment fees if you change terms, cable charges for international transfers, and sometimes a claim charge if the guarantee is called. The risk of the beneficiary making a call is a major factor. Guarantees with a higher perceived risk, perhaps related to complex or volatile projects, will face higher charges. The bank also assesses its own risk, the chance of being unable to obtain reimbursement from the applicant if the guarantee is called. Your creditworthiness and financial stability directly influence this cost. Let's put this into context using a construction project, where a bank issues a performance guarantee to the client. A larger contract value means a higher guarantee amount and higher charges. Similarly, a longer project duration increases the guarantee's validity period, leading to increased fees. If the contractor has financial difficulties, the bank perceives a higher non-reimbursement risk and charges more. More complex projects also inherently involve higher risks, potentially increasing charges. Before you apply, keep these 3 key considerations in mind to manage your costs effectively. Don't just accept the first quote. For large or complex transactions, applicants can and should negotiate guarantee fees with the issuing bank. In some scenarios, alternatives like letters of credit might be more cost-effective. always explore other security arrangements before committing to a bank guarantee. Transparency is vital. You must understand the bank's entire fee structure and associated terms and conditions completely before the guarantee is issued. To summarize, bank guarantee fees are dynamic and depend on the instrument's value and validity, the risk of a claim being made, and the bank's risk of non-reimbursement from you. We covered the definition, different types of guarantees, the 4 charge criteria, and key negotiation points. What's the most surprising factor you learned today that influences the cost of a bank guarantee? Let me know in the comments below. Thank you so much for watching. If this video helped you understand bank guarantee charges, please hit that like button and subscribe for more essential financial education content. See you next time.